As the Fed meets today, ahead of their decision on monetary policy tomorrow, investors are turning their attention to what happens after the expiration of QE2. There are a number of divergent views. The most common view is that it's a non-event. The economy is self-sustaining, and strong earnings will support the stock market going forward. Larry Cantor, head of research at Barclays, is in this camp, saying, "It's not the beginning of the Fed tightening, it's the end of the Fed easing." The next most popular perspective is that the end of QE2 means rising interest rates. This view is associated with Bill Gross and PIMCO. Gross articulated his argument in his March investment outlook: 2 bits, 4 bits, 6 bits, $1. It's pretty much economics 101. The Fed has been buying 70% of annualized Treasury issuance. Once you remove a huge buyer from the market, it's essentially a reduction in demand. We all know when the demand curve moves to the left, the clearing price is lower. Because bond prices and interest rates are inversely related, lower bond prices means higher interest rates. Now, there is a minority view that the end of QE2 will actually counterintuitively mean higher interest rates. Rick Ryder of BlackRock and Jeff Gundlach of DoubleLine are in this camp. Now, on the surface, it seems to defy logic. If you remove a huge source of demand, price should go down. But they do point out that the recent history suggests otherwise. When QE1 kicked into gear, interest rates actually went up. When it expired, the 10-year Treasury hit a peak of 4% on April 6th. QE1 expired on March 31st, 2010, and it dropped 160 basis points in the next 6 months. When QE2 started to be talked about in late August 2010, the interest rates started to rise, and so if history repeats itself, the end of QE2 would mean lowering interest rates. To understand this view, you need to understand that over the last 30 years, the Fed has pretty much bailed out Wall Street in the event of any crisis. Starting with Continental Illinois Bank in 1984, through Greenspan's statement that the Fed stands ready to provide liquidity as needed to support the economy and financial markets after the 1987 crash, through the bailout of long-term capital management in 1998, all the way through the recent interventions in 2008, 2009, it's become an axiom on Wall Street: don't fight the Fed. This has created a risk-on mentality, especially when Fed policy is easy. The last 2 years have been a microcosm of this. During QE1, the market soared. As soon as it expired, risk assets sold off, and we had that nasty correction last spring. And then the stock market and financial assets gyrated around until we got Bernanke talking about QE2. Then all of a sudden, starting in September, they've just levitated now for the last going on 8 months. Now, if the playbook plays out this time, we should expect a correction in risk assets, small cap stocks, cyclicals, and emerging markets, as well as commodities. Now, because treasuries are considered a safe haven investment, even risk-free, in the short term, sell-offs and fear in risk assets corresponds with an appetite for treasuries, which pushes up their price and pushes down interest rates. As I think Reader and Gundlach are going to be right in the short term. I think that if we do get this sell-off in risk assets as QE2 expires, we're going to get a rally in treasuries, as that's the flight to safety asset. However, over the longer term, Gross is surely right that we're going to have to pay higher interest rates to fund our $1 trillion plus deficits, because who's going to buy that stuff at current rates? John Burbank, head of a multi-billion-dollar hedge fund called Passport Capital, based in San Francisco, California, also thinks that the end of QE2 means a correction for risk assets. But he goes a little bit farther and forecasts how he thinks the Fed will react to this. If the sell-off gets bad enough, here's what he says. He says, "I don't think the Fed will tolerate a situation where asset prices are meaningfully lower. And that's when we get a version of QE3.